Good morning. As Galen said, I'm Greg Hallman. I'm a senior lecturer in finance, and I teach investment courses, valuation courses, and some real estate finance courses across all three or four of the degree programs at McCombs. And I am also the director, as Galen said, of our still relatively new Master of Science in Finance program, the MSF program. And so at the beginning of our session here, I want to take a few minutes to tell you about the MSF program. I cannot miss an opportunity with all of you sitting still to promote my new program. So I'm going to take a few minutes to do that, and then I'm going to show you part of the new program by introducing my three MSF student panelists who are going to talk to you about the Fed and the Great Recession. Before we get into the Fed, though, let me tell you about the MSF. The MSF program is a one-year graduate program in finance where we teach all of our MBA finance courses, plus a few quantitative investment classes that were specifically designed for the MSF. In addition to the heavy dose of finance that they get in 1 year, they also take courses in statistics, a lot of financial modeling in Excel, and they take a full set of accounting classes, financial accounting, financial statement analysis, intermediate and advanced accounting, all taught by our #1 accounting program in the country. And we think that that set of training would make for very good financial analysts for many firms. The students in the MSF program are younger than MBA students. The program was designed for students right out of undergrad or maybe 1 or 2 years of experience, not really the type of student now that goes into top 20 MBA programs, but there is demand from those students for graduate training. And we also believed that there was demand on the firm side for highly trained analysts with MBA level skills. About half the students come into the program with backgrounds in economics or business, and the other half, we have a great variety of undergrads. We have a degree in biology, international studies, a government degree, who you will see today, physics. I have 3 engineers, I have 3 actuaries, and I have a history and Russian major who graduated with honors from WashU, who we are teaching finance to also. All of our MSF students, what is in common across all of them is that they all show up at the program with very strong quantitative skills. We find evidence of that on their transcripts or in their test scores. If we're going to teach them MBA level finance in 1 year, they have to be good at math at the start. They can't struggle with the math along the way if we're going to do this all in 1 year. And it is a tough program. It is a lot to do in a year. It's a lot to take all those MBA finance classes in 1 year plus all the accounting classes. And the benefit of that for recruiters is by the end of the year, the students certainly know how to work hard, or they would not make it to the end. And our thought when we did this was that we believe that by adding graduate level finance skills to both econ undergrads, business undergrads, and a wide variety of different undergrad majors like the biology majors and the government majors, that we can create some very, somewhat unique and very capable human capital. I was in consulting for a lot of years before I came back here to the faculty in 2002, and I worked for a few large national consulting firms, and it is very much my belief that organizations are much stronger when they have a lot of smart people that come from different backgrounds, different training. You're always going to get better new ideas if you can mix in folks that were not all trained the same way. And so we think that by taking some of these undergrads from the non-business disciplines and adding these finance skills to them, we can make an analyst that would really add a lot of value to a lot of different organizations. And the students have placed very well. They've joined the big 4 accounting firms, often in the valuation and advisory services groups, also in just the general consulting. We have students going to general consulting firms. I said we have students going to investment management firms, and quite a few of them last year joined energy firms in Houston. So now that you know about us, I want you to, if you could please keep us in mind when you are looking for analysts. We think that we have a unique product, a product that you don't see everywhere else, a lot of really great students. And those students come from all over the country, but I can tell you most of them fall in love with Texas while they are here, so I'm sure they would be happy to stay if you have opportunities for them. All right, so thank you for listening to my pitch on the new program. And so now on with our show of the Fed and the Great Recession. I don't know about you, I teach, and so I talk at the beginning of each one of my classes about what's going on in the world and the capital markets. And I don't know about you, but it has been my feeling many times over the last 5 years that this is the Fed's world, and we are just living in it now, I think. And the Fed has done a lot of good. I think there's no denying that. But as a free market economist, I got to tell you, it's at least a little bit troubling to see the Fed and the Fed's influence just everywhere in the capital markets. Everywhere you look, people talk about the Fed. They talk about the Fed in Europe. They talk about the Fed, the Fed, the Fed. And so we thought, with the opportunity we have to listen to Richard Fisher today at lunch, who's just one of my favorite people to listen to talk about the economy and the Fed, that we would present a short kind of primer on how we got here. How did we get to this place in the world where the Fed is kind of everywhere in the capital markets now? And how might they ever extract themselves from this? So I have a few students here that let me go ahead and introduce my student presenters so we can get to the topics. Our first presenter is Evan Gill. Evan came to us from Brown University with an undergrad in econ, and Evan will be joining Dimensional Fund Advisors next year here in Austin in their investment analyst rotation program. And Evan is going to give us an overview of the Fed's responses to the recession starting about in the Bear, Stearns, Lehman time up through about today. And then Evan will hand it over to John Hawkins. John comes to us, he grew up in Houston, went to NYU undergrad, has an econ degree from NYU, and came here to our program. And John will be staying in Texas. He's joining Capital One up in Dallas next year. John is going to give us a picture of the economy today. So we are presenting what the Fed did. We are presenting the economy we have now. I'm not arguing exactly that what they did caused the economy we have now, but those are both facts. They did these things. We have this economy. We will probably argue for years about how much what they did caused the economy we have today, but we are going to present to you what we are looking at today. And that's what John's going to go over. And then finally, Nina Sidorinskaya is going to talk about one of the biggest unknowns of the Fed now, which is that after many, many years, we have a new boss at the Fed. And Nina's going to tell us something about the background and some of the public views of the new Fed chairwoman, Janet Yellen. Nina got her undergrad degree here at UT in government and worked for a few years here in Austin, both with the state government and in politics. When Nina came to talk to me last spring about the MSF program, she told me that in all of the issues that she had worked on and all of the things she had worked on in politics and in the government, the common denominator was, boy, a lot of it sure was about money, she said, and said she was going to come back and get a degree to learn about the money. And so she is not going back to politics just yet. She is also joining Dimensional Fund here in Austin, more on the client side. Evan will be looking at more screens, and Nina will be looking at more customers. So, without further ado, Mr. Gill, the floor is yours. Please take it away.
Thank you. I must say, I think this is the largest group of people I've ever spoken before, but I've been told that you're a very friendly crowd, so. All right, let's get started. What I want to do is I want to take everybody back to 2008 and talk about what the Fed did in the depths of the financial crisis. And the financial crisis, I know it's hard to believe that it's been 6 years since the financial crisis, but it's still very much in the news. On the front page, or in the Wall Street Journal today, there was an article about a bunch of internal memos that were released that kind of detail how Bernanke led the Board of Governors during the financial crisis, and how Yellen interacted with various members of the Fed. So let's go back to 2008. And I want to give you a very brief overview of the financial crisis. I know that it's very much still, the nuances and intricacies of what caused the financial crisis are still very much up for debate, but I think it would be fairly non-controversial to make three very general points. First of all, housing prices began to fall sharply. And the reason this was problematic is that banks held large amounts of securities that were backed by mortgages. And once these housing prices began to fall, it put a lot of downward pressure on these mortgage-backed securities. and the financial sector didn't really know where the losses were going to fall. A lot of banks held these securities, and there was just a lot of uncertainty about, which banks were okay and which banks weren't okay. And to complicate matters, these things are extremely hard to value, and banks did a pretty good job of hiding them on their balance sheets. So there was just a lot of uncertainty in financial markets due to these facts. So broker-dealers like Morgan Stanley, Lehman, Goldman Sachs, and banks as well, they're really dependent on short-term funding to finance their balance sheets. And due to this uncertainty, due to falling housing prices, and as a result, declining mortgage-backed security values, nobody wanted to lend to the banks anymore. Short-term funding was really drying up. And when the banks can't get short-term funding, this is extremely problematic. I think this graph really summarizes the problems that we saw in short-term liquidity. This is the LIBOR spread, or the LIBOR rates, which are these are interest rates that banks are charging each other overnight. This is fairly routine. Banks lend and borrow funds for very short periods of time just to, make sure they have enough cash on hand to conduct their operations. And as you can see, the LIBOR rates tend to move in these stair-step patterns. And this is, LIBOR rates move in lockstep with the federal funds rate, which is the rate that the Fed is targeting. So the Fed usually has a pretty good control over the rates that these banks are charging each other for short-term funds. But as you can see, in the fall and winter of 2008, when Lehman Brothers collapsed, LIBOR rates just shot through the roof. Banks just didn't want to lend to each other. They didn't know that their peer institutions were insolvent, but they didn't want to take any chances. So this made it really difficult. Banks couldn't get the short-term capital they needed. So how did the Fed respond to this really serious issue? Well, what the Fed did, and I'd like to pause for a second, and I know when you're recalling the financial crisis, there were a lot of actions undertaken by the Treasury Department and the Fed, and it's kind of a whirlwind when you're trying to recall what exactly happened. But I like to think about it like this when I'm separating the roles of the Treasury and the Fed. The Treasury focused more on the solvency side of things, whereas the Fed really worked to promote liquidity and make sure the banks could roll over their debt. So how did the Fed work to promote liquidity and make sure capital markets didn't completely freeze up? Well, the number one tool they have in their arsenal is discount lending. And during normal times, banks are really reluctant to borrow through the discount window because, markets, when a bank's borrowing through the discount window, markets are really skeptical about why do they need to go to the Fed to raise capital? Like, they can't raise capital through financial markets. What's wrong with them? So the Fed really there was a stigma attached to borrowing through the discount window. So the Fed really had to work to combat that stigma. And they did some innovative things when it came to discount lending. They actually auctioned off some funds rather than making banks come to them to get the funds. So they invoked special powers that the Fed is able to do only in exigent circumstances that allowed the Fed to lend to broker-dealers, which that's normally not their jurisdiction to lend to broker-dealers, but a lot of the crisis was centered in these broker-dealers. So the Fed felt it necessary to expand their powers to allow them to get liquidity into these broker-dealers. And they also established a lot of special liquidity and credit facilities. Let me explain to you or give you an example of one of these facilities. Now, broker-dealers are really dependent on one source of funding that they rely heavily upon is commercial paper. Commercial paper markets completely froze up after Lehman. So the Fed, wanted to get money flowing into these commercial paper markets again. So they set up something called the Commercial Paper Funding Facility, the CPFF, which was a special vehicle that bought up commercial paper and really drove down spreads in commercial paper and helped banks roll over their short-term debts like they do in normal times. And let's go back to the LIBOR graph again, because I want to show you how quickly these are short-term. I mean, this is going to be seen as a proxy for short-term interest rates amongst financial institutions. So when it spiked to about 7% after Lehman Brothers, banks just couldn't get the funding they needed. And the Fed stepped in to provide liquidity. And as you can see, LIBOR rates very quickly went down to levels that seem more normal, that were closer to the Fed funds rate, which meant that banks were, again, getting the capital they needed. The Fed also intervened to save a couple of systematically important institutions, and I think especially important is AIG. So the Fed and the Treasury worked together to make sure AIG didn't go under. The Fed, set up another one of these special purpose vehicles that bought up a bunch of AIG's debts, and I think, they extended an $85 billion, I think it was a $65 billion loan to buy up some of AIG's assets. And the reason this is important is AIG, what they did is they're a huge insurance company, and they insured against a bunch of these financial products that the banks were buying. They insured against defaults in these products. Subprime CDOs, which banks held quite a bit of. AIG actually insured against default in these securities. And the banks thought they had, the banks weren't completely stupid. They at least, they saw it coming to an extent. So they hedged some of their exposures to subprime CDOs through credit default swaps which they purchased from AIG. However, if AIG goes under, these credit default swaps aren't going to be honored, and the banks are, in an even deeper crisis. And Bernanke thought that, this would be the end, basically, if they allowed AIG to go under, because all of these financial institutions that had hedged their exposure through credit default swaps, they're now in trouble. So the Fed intervened to prop up AIG, which I think it helped prevent an even deeper crisis, I think it's safe to say. Okay, let's talk about QE a little bit before I hand it over to John. So the Fed typically only buys government securities, T-bills, in order to provide, credit easing. However, during the financial crisis, the Fed felt it necessary to start buying up agency mortgage-backed securities to help get credit flowing into mortgage markets again, and hopefully help prop up housing prices by lowering mortgage rates and improving access to mortgages. So by the end of 2009, they had bought over $1.25 trillion of agency mortgage-backed securities. And to be clear, these aren't the private label mortgage-backed securities that really led to the financial crisis. These are mortgage-backed securities that have been packaged and insured by Fannie Mae and Freddie Mac, the so-called GSEs. But this did nonetheless help get money into mortgage markets and help drive down a key interest rate, which is the rate people pay on their mortgages. So in summary, I think it's safe to say that the Fed, during the financial crisis, they really tried their best to provide liquidity and make sure credit markets didn't seize up, because if banks can't get credit, they have a tough time staying afloat. And they also supported the housing market by increasing funds available for lending by buying these agency mortgage-backed securities. I'd like to end with this graph. And this graph shows the Fed's balance sheet, since 2002, from before the financial crisis until after the financial crisis. It's really hard to read, but the red line is mortgage-backed securities. So normally, before quantitative easing, the Fed does not own these things. But during the financial crisis, they bought a lot of mortgage-backed securities, and in early 2010, or through most of 2010, they actually had more mortgage-backed securities on their books than Treasury securities, which is extremely unusual, and it's unprecedented, really. And the green line is their traditional holdings. Another aspect of quantitative easing was the Fed began buying longer maturity Treasury securities to try to push down interest rates. And that really picked up with QE2 and QE3. I think John may have time to tell you more about QE2 and QE3. So without further ado, I'd like to introduce Mr. John Hawkins, who will take you through the aftermath of the financial crisis up until today, and tell you about efforts the Fed is taking today to try to continue to stimulate the economy.
Thank you, Evan. All right. So I'll be honest, I really don't know what quantitative easing means. I would be very glad if one of you could tell me what it means. It's a very strange kind of Orwellian phrase. But I do know that it is actually very similar to what the Fed does every day since it was instated. Buy bonds by printing money at about 2% a year, just a whole lot bigger than that. So this is the St. Louis Adjusted Monetary Base. It's basically money in your back pocket, money in a bank vault, reserves held at the Fed or on a digital ledger somewhere. And as you can see, it just explodes as the Fed starts to print money in about the end of 2008. You can see QE1 going from a big spike at the end of 2008 and going all the way to 2010. And then QE2 starting around 2011. You can't see Operation Twist because that had more to do with the asset side of the balance sheet than the liabilities side. But then you can see QE3 starting in 2013 and ongoing, even though it's beginning to slow down and taper. And here's the effect of Twist on the balance sheet. As you can see, the dotted blue line is the percentage of bonds they have with an under 5-year maturity. They sell short-term bonds and buy long-term bonds in a hope to lower interest rates on long-dated maturities, since most mortgages are 15, 30 years. You'll actually hear a lot about this because since they have longer duration bonds, their assets are more sensitive to interest rates. And they've been tossing around the idea of going to a cost-based accounting rather than a mark-to-market accounting. This is very important because the Treasury has to actually plug any gaps if the Fed has a loss on a quarterly basis, the same way the profits of the Fed go to the Treasury. So this, as Evan was saying, is why they started buying all the MBS they could. As you can see, the big old housing bubble over there, people riding high. As Dr. Hallman says, it looks a little bit like a volcano blowing off the top, and we're trying to find how far down the floor goes in 2008 there. And not much really happened despite all the purchases that the Fed made until about 2012 with Operation Twist and QE3. The market didn't really respond to the earlier purchases. The stock market, however, seems to have been responding to everything the Fed does. If you follow the stock market, anytime there's an FOMC meeting, it's all hell breaking loose after that. You can usually guess that the market's going to go up or down a percentage point after something comes out of Ben Bernanke's mouth. What's interesting is the price level seems to have not reacted to all the money printing. I don't know if you remember how in 2007, pretty much, there was a voice for all kinds of ideas. Tons of people were saying we were going to go back to the Weimar Republic. You'd be a reasonable person if you said, oh, I think we'll have some kind of 1970s inflation. But we haven't even been able to get back up to 2%. And there's a lot of theories about that. Maybe the Fed's adroitly maneuvered through this recession, but it's also possible that it hasn't been really stimulating the economy as much as it would like to. So this is a ratio of the total value of the equity market, the Wilshire 5000, divided by GDP, the gross domestic product. You can see the internet bubble at the end of 2000, how far the equity values outstripped the underlying economy. And you can also see around starting in 2009, the asset markets really outstripping GDP. And there's been a lot of fear that what the Fed has done is really just gin up asset prices and produce what people call asset inflation rather than do anything actually for the economy. So this picture has been bouncing around the internet a lot under the name the scariest job markets chart ever. And you can see it's been the worst labor market in any post-World War II recession. We still haven't gotten back to the employment levels we had back in 2007, despite really Herculean efforts on the part of the Treasury and the Fed. Which is interesting because if you look at the unemployment numbers, they keep coming down, and that's one of the main things the Fed looks at when it makes its Fed funds rate. The latest register was around 6.6, 6.5%, and that was actually the threshold that the Fed set where they'd start having a little more discretion and maybe letting interest rates rise off the floor they've been on. But unemployment can be a difficult thing to measure. These are a bunch of different unemployment measures that add discouraged workers, people who are working part-time but would rather be working full-time, people who are marginally attached to their work. They all send the same signal that unemployment's coming down, but how far down it's come down, they send different signals in that regard. And in fact, none of these measures really take into account what's called participation effects. So let's take an imaginary economy where we start out in a recession, we have 13 unemployed people, and as we start to recover from this recession, we finally get to where we only have 6 unemployed people. It's kind of a natural rate of unemployment with the frictions in labor markets. But if you look at what's happened in this scenario, we've gone from 52 to 54 jobs. We've only made 2 jobs, and what's actually happened is 5 people have dropped out of the labor force. They've gone into retirement or decided to go get a Master of Science in Finance. And if you actually look at the employment population ratio and the participation to population ratio and think of the difference between those two as the unemployment rate, you can see since the recession ended, the employment population ratio has stayed flat, and the entire change in unemployment has come from drops in the participation rate. So what is wrong with participation? And the reason I'm talking about this so much is because Janet Yellen's expressed a lot of concern about this and that maybe we should pay more attention to broader statistics of how the employment and labor markets are doing other than just unemployment, and maybe be more dovish. If we look and kind of disaggregate the employment numbers a little bit, we can see that participation tends to drop off with age as well as pick up depending on how much education you have. There's a much higher opportunity cost for a person with a PhD to be unemployed than somebody who's just graduated out of high school. So if we make a kind of a model, I didn't do this, but somebody else did. If we make a model just looking at the data based on the baby boom getting older and where education levels are right now, we can see that the boom times in the 2000s were actually a little boomier than they should have been, and participation was higher than it should have been. And now it's really, we've only dropped off about a percentage point from where we should be if we look at kind of how old and how educated the workforce is. So the picture I tried to paint is one where there are a lot of ambiguities as far as how well we're doing, but we know it's not 2000 anymore, and we have a pretty decent economy. So now to take this simple task of what the Fed and the economy will do going forward, I present Nina.
So Janet Yellen made history when she shattered the glass ceiling and became the first woman to head the U.S. Federal Reserve System in its 100-year history. We'll get to know her much better over her term spanning through February 2018, but what I'd like to do now is take a look at what we know about her at this point and what the Federal Reserve may look like under her leadership. Miss Yellen was born in 1946 and grew up in Brooklyn, New York with her parents and her brother. She excelled academically. She was her high school valedictorian and earned her bachelor's degree from Brown University, followed by her PhD in economics from Yale, where she studied under prominent Keynesian economist James Tobin. From a professional standpoint, if you were to dream up a training school for the position of Fed chair, look no further than to Miss Yellen's life story for your curriculum. She's had nearly a decade of experience in the Federal Reserve, first as a governor, then as chair of the San Francisco Fed, most recently as the vice chair, and now as the chair. She has served on the faculty of Harvard, UC Berkeley, and the London School of Economics, and her macroeconomic research specializes in the causes, mechanisms, and implications of unemployment. Not only did Miss Yellen find a career at the Federal Reserve, she also found love there when she met her future husband, George Akerlof. Mr. Akerlof won the Nobel Prize in 2001 for his research in the lemons market. Together, the two have a son who is also in economics. They enjoy hiking and playing tennis together. They've published economic research together, but economics is always at the forefront of their minds, as their friends say that they consider a suitcase full of economics books an essential on any relaxing vacation. So we've discussed what the Fed has been doing. What do we think it's going to do in the future with Miss Yellen at the helm? She's certainly determined, disciplined, and brilliant, but what we must remember about her is that she's the product of a progressive tradition of activist economics. She's known on Wall Street to be a dove, equally concerned about jobs and living standards as she is about combating uninflation, but some predict she may act more as a hawk if economic circumstances dictate. From that position, she's pushed aggressively for easy money policies, including the third round of bond purchasing at the end of 2012 to stimulate borrowing, spending, investing, and hiring. As you know, the Fed's quantitative easing program has recently been modestly reduced from $85 to $75 billion per month. And in her debut as Fed chair, Ms. Yellen set a familiar direction for the Fed, promising to pursue the policies of her predecessors and leverage monetary policy to help support the economy and the labor markets. As the economy gets healthier, she will gradually tiptoe away from these policies. In 2012, the Fed indicated that they would consider the U.S. labor markets healthy when unemployment drops to a level of 6.5%. We're currently at 6.6, but many worrying signs in the job market remain, and the underlying causes of these declines are up for debate. We see that long-term unemployment remains high. People have stopped looking for work, and the share of Americans with jobs has not increased since the recession. These factors taken together indicate that we may see interest rates stay low for a long time to come. Overall, when contemplating the 6 hours of testimony that Ms. Yellen gave a couple weeks ago, we can draw a few key takeaways. First of all, the tapering is on track, and the U.S. economy would need to take a notable turn for the worst for the Fed to stop pursuing its slowdown of bond purchases. As we've mentioned, the labor market weaknesses remain worrisome and indicate that we're far from a recovery. In the same vein, the Fed is de-emphasizing the unemployment rate and focusing on other indicators of job market distress. The Fed rejects the claim that its move to scale back its bond purchasing program led to the massive sell-off in emerging markets in January and rather is pointing at other adverse developments, such as the weak Chinese manufacturing numbers that led to this turbulence. At this point, Ms. Yellen says it doesn't seem to be a threat to the U.S. economy. And finally, rather than surprising people, this Fed is poised to act predictably and transparently and communicate stated goals. To sum up, Evan kicked off by telling us a story of a very active Fed dreaming up program after program. Dr. Hallman pointed out that it's a little distasteful to consider that we have the freest capital markets in the U.S., yet rely so heavily on the Federal Reserve. What we know at this point is that the Fed under Ms. Yellen will certainly be accommodative, but not in the way that Evan described. This is not the Federal Reserve of 2009, and we look forward to seeing where it goes under Ms. Yellen's leadership.
Thank you very much, Nina. Very nice. And if you guys could join me for a big hand for these students. Thank you very much to all of you.